So there's one last super important piece here. We don't want to miss out on our interest expense deduction, right? Because let's say we paid $800 as our first payment. Well, some of that is going to be interest and some of that's going to be principal. So I just reduced the principal of this loan by the full payment, but that's technically not accurate because some of that was actually interest expense. So even though I paid $800, I'm going to probably still owe $48,200 or $48,300. I'm going to still owe a piece on this because I paid a piece of interest. So a lot of times what we'll do is we'll do this quarterly, monthly. Some clients just do this once a year, but at some point in time, you'll get an interest statement, or you can go onto your loan account and pull that interest statement. And when that happens, what you're going to want to do is do another journal entry to record the interest and increase this liability account for that piece. So let's just pretend that we've made our first monthly payment. We looked at our loan statement or gone online and pulled that information, and we've determined that let's just say, to make it easy, $200 of the $800 was interest, right? And the other 600 was principal. So if that's the case, I want to make sure that I'm getting that interest deduction on my profit and loss, and also that I'm not under-reporting the note payable that is remaining. So what I'll do is I'll do another journal entry, plus journal entry, and we can set it as of, let's just say, March 2nd. Let's pretend that's when that payment was. So the debit will be interest, and we don't have an interest account in this QuickBooks, so I'm going to add interest expense. That's going to be an expense account. And interest paid. I guess we could call it interest paid if we wanted to. All right. So that's adding this expense account. And I don't know why. I guess it didn't save. I'm sorry. So let me duplicate my tab and fix that. So if you ever make a mistake like that, you can pull up your chart of accounts by going to the settings, chart of accounts, and I'm going to search for enter, and I'm going to edit this and change it to interest paid. I'm not sure why it didn't save the first time. Okay, there we go. So let me go ahead and redo this. So I'm going to do plus journal entry. I'll go ahead and set it for March 2nd. The debit is interest not interest earned, interest paid. There it is, $200. And then the offset to that is going to be this liability account, which is the F-150 note payable. So what we're doing is we're increasing that note payable, but the offset to that is this deduction that we're going to take on our profit and loss for interest. So this is going to be, we're going to call this March interest expense. Whoops, March interest expense. I'm going to put my initials here, and I'm going to hit save and close. And now, if I were to run my balance sheet as of March 2nd, and then I am to scroll down, you'll notice, obviously, the fixed asset, it will remain at 50,000. And then my note payable balance went from 48,000 to 48,200. And that's because we've had three things happen. The first thing we did was we added the $48,800 initial loan balance. Then we reduced that by $800 for the payment, but then we bumped it back up $200 because part of that payment was interest. So now, as of March 2nd, we're saying, okay, this is how much I owe on this loan. So this is the correct way to enter a fixed asset onto your books, record the payments against the liability, make sure that you're getting that full interest deduction each year. And then the last thing we have not yet hit on is that depreciation, right? So obviously there are different ways to calculate depreciation. Sometimes you might want to calculate it, using like a straight line method. A lot of times for tax purposes, you're going to accelerate that depreciation. And so maybe you want your books to match, what the tax return says. So with depreciation, it's again a journal entry. That's what we're doing today, our journal entries. So in today's video, let's pretend it's the end of the year and we're prepping our tax return, and we're going to take section 179 and we're going to deduct all 50,000 of this all right now in 2025. And if we do this, we have a couple different options, right? We can have a book tax difference. We can leave the books with like a straight line depreciation, or we can just match it to the tax. So we can say, hey, I've written all this off. That's how I want to see it on my books. So that's what we'll do in today's example. So I'll do plus journal entry. I'm going to set this at 12/31 of 2025 because this is going to be as of the last day of the year. And I'm going to add a depreciation deduction. That's going to be, other expense. If you remember, there was a sub account. This is, I think, the accumulated depreciation account on the balance sheet. This is the expense account. So let's use this expense account because we're saying we did section 179. We wrote off all 50,000 of that on our 2025 tax return. So I will say 2025 section 179 depreciation deduction. That's what this debit is. The offset to that is going to be accumulated depreciation. So what I like to do is just have a kind of a catch-all account for accumulated depreciation. And I also like it to show up at the bottom of the list. So you can kind of do that by the sub-account method, or you can just put a Z in front of it. So that's what I'm going to do. I'm going to put a Z in front of it. This is going to be a fixed asset account. It's accumulated depreciation. I'm going to hit, let's see. It doesn't like it being a sub account actually, or a parent account. So I guess I'm just going to call this one. I'll put it under vehicles, and that way it'll lump together with that F-150 that I already created. So here are my initials: 12/31/2025. Here's my expense on the profit and loss, and then here's the offset on the fixed asset side of the balance sheet. So save and close. So let's look at two things. Let's start with the profit and loss. So I'm going to go to reports, profit and loss, and then I'm going to run it for this year, 2025, run report. And if you scroll all the way down, you'll see this $50,000 has made it onto our profit and loss. However, it's taken us negative, so this isn't a great example. However, we can pretend that we had more income up here to take that section 179 and stay positive or break even. But right now, this is the main thing that we want to look at. We've seen that this depreciation deduction has been added as an other expense item. And then if I pull up the balance sheet again and run it for as of 12/31/2025, you'll see right here I've got my Ford F-150. You can ignore this, but then here's the negative 50. So I've written off all 50,000 of this. And then at the bottom, we would have been making payments, so this number would have continued to shrink throughout the year as we made these payments, and our interest expense would continue to increase on that profit and loss. But this is kind of a general video of how to use journal entries to add the fixed assets, the interest expense. So if you found today's video helpful, please give us a thumbs up, leave a comment. If I wasn't clear on something, let me know. I'd be happy to release another video with more info, or obviously respond in the comments below. Thanks again. Again, I'm Nick Grantham with Sullivan and Grantham PLLC, and we'll see you next time.